Probably one of the most misunderstood topics in the entire real estate industry. So most people who explain gap funding get it wrong. It's not one product, it's not a single loan, it's not a magic lender who covers everything. Gap funding is a system, a specific sequence of capital tools stacked together in the right order and covers the gap between what your primary lender covers and what your deal actually costs. So done right, it doesn't just fund one deal, it builds your capital capacity to take on more deals simultaneously and scale faster than investors stuck using their own savings. So let's get in. I'm Mick Wadley, founder of gapfunder.com, where we're helping investors and business owners access the capital they need to close deals and scale their portfolios. So gap funding is the primary methodology the company was built around. And here's our mission. There's a lot of confusion about what gap funding actually is. This is the clearest, most honest explanation you'll find on the internet, and it's built from the ground up by the team that named their business after the strategy. There's a link in the description below if you want a free funding review. No obligation, of course, as a soft pull, no hard credit check. Takes 2 minutes, and then we can actually map out a game plan for you to not only get into your next deal, but scale your portfolio more predictably. So here's the problem, the gap that stops most investors. You find a deal, the numbers work, your hard money or DSCR lender approves you for 75 to 80% of the purchase price. So let's look at a 200K purchase, and here's what's left over. You got your 40K down payment, you've got your 6K in closing costs, first rehab draw. So a lot of first timers don't realize that you've got to make it through the first draw period before they'll actually release the funds. So you're going to have to pay those contractors if need be to get to that first draw. And then the total gap we're left with is 68K. Most investors drain their savings, give away 30 to 50% profit to an equity partner, or just walk away from a deal that worked on paper. Gap funding is the fourth option. The one that also sets you up for the next deal and the one after that. So here's the alternatives and why they don't scale predictably. Every investor encounters three approaches pitched as solutions to the gap problem, but none of them are reliable or a repeatable system for scaling your portfolio. Let's look at private money first. So flexible terms, fast access, but equity splits can be 30 to 50% on your first deal, and they're going to be underwriting your deal. And I have people come to me every day where their private money lenders pulled out of the deal with 1 week to close. So that's private money. Let's look at second liens. This is secured against the same property as your primary loan. They almost are non-existent unless you go through the same lender that gave you your hard money. So most hard money lenders explicitly prohibit this, triggering immediate loan recall or pulled approval. So if they find out this halfway through the flip, for example, they might call the debt due. Now you owe that money before you finish the deal. Thirdly, creative finance. Seller finance and subject to work in specific circumstances, but they're seller dependent, legally complex, and build zero credit history or lender relationships. So unless you're on the phones all day as a wholesaler and finding these 1 in 50 deals, you got to remember, if they do agree to seller finance, they're going to expect a higher sell price as well. So that's crushing the profit in your deal right there. Let's go deeper on private money, the hidden costs around it. So the pitch is compelling, flexible terms, fast access, no bank involved. The reality is far more expensive. The equity split problem. So on a deal with 46K net profit, 50% split costs you 23 grand. The gap funding stack on the same deal costs 3 to 5 total. Multiply this across 10 deals. The private money investors left 200 grand on the table, not through bad deals, through the wrong capital structure. And then the scalability ceiling is a single private money investor has a finite capital pool. As deal flow increases, you become dependent on one person's availability or an expanding network of individual lenders, each with their own terms and timelines. And now you've got their opinions on how the deal should be done, when you should exit and how you should exit as well. So useful as a supplement once you have a track record, expensive, relationship dependent, and non-repeatable as a primary strategy. And don't get me wrong, if you've got an uncle or a family member willing to get in on the deal, go and utilize it, but it's not something to scale or rely on. So, second liens and creative finance. Here's the other traps involved. Second liens are approval killers. Most hard money lenders explicitly prohibit them on their collateral. So if we're looking at the deal that you're looking to get done, discovery means the loan is called due immediately if they find out. Two secured lenders competing for the same asset creates adversarial dynamics. And the additional documentation burden can kill a deal that needs to close in 5 to 10 business days. Technical default from the moment the second lien is recorded. And let's look at the creative finance. So in a sub 2 deal, due on sale clause allows lenders to demand full repayment of ownership changes, builds zero credit history and zero fundable profile. You run the risk of having to pay that entire mortgage amount if they call it due. Then let's look at seller finance. It requires a seller who doesn't need cash at closing. So most do, and it's a lead generation strategy, not a capital strategy. Fine if you're cold calling all day, you're a wholesaler, but most aren't. People are building these portfolios on the side of a job or, to build wealth for their family over time. Every deal starts from scratch. It doesn't stack, it doesn't compound. So here's a full breakdown. Let's look at private money, profit retained. Sometimes you're only walking away with 50 to 70% of the profit. On a second lien, yes, it's 100, same for creative finance and gap funding. The reliable availability, this is very relationship dependent. Secondly, finance is seller dependent, and typically you have to give them a higher sale price to make it work. And the difference with the gap funding stack, which we'll go over here in a second, is it's always available and continually expanding. Speed, this is a massive one. As we know, deals are always time dependent, depending on whether or not you can get an extension. Private money is variable. Second liens are fast but risky. Creative finance is slow. And the gap funding stack, we can even get the first part of the stack done in 1 to 3 days. None of these build business credit. Our unique gap funding stack method does on every deal. And the capital capacity growing, none of these do that, apart from building relationships over time with obviously private money. However, the gap funding stack will continue to expand your capacity to take on more deals over time. Go from doing 1 deal at a time to 2 to 3. Private money, second liens, and creative finance are all deal by deal negotiations, whereas our gap funding stack is a compounding system. And that's the difference between tactics and infrastructure, putting yourself in a better position in a year's time once you've done those first couple of deals and rinsed and repeated. So what is gap funding really? Gap funding is a strategic sequencing of multiple capital tools stacked in a specific order to cover every cost component of a real estate deal that your primary lender doesn't fund. It's not one product, it's a methodology. So let's look at it. We can go and stack term loans together. So this is unsecured personal or business loans, dependent on which route you want to go. And it's deployed in 1 to 3 days, typically fixed rate, fixed term, no lien on the property. We can even get 5-year terms to lower your monthly repayments, which is your carrying costs. And there's typically no early pay down penalty. So you just pay them off once the deal's done. Then we can move into 0% business credit card stacking. So these are typically 0% intro periods of 12 to 21 months, and they can be liquidated into your bank account as cash to use for covering rehab floats, holding costs, reserves, down payments, whatever you need it for. And most of the big business credit cards won't report utilization to your personal credit profile, so you're welcome to go and max them out on the deal, and it will. HELOCs. This is such an incredible tool for investors. Some of the cheapest capital you can get and most accessible as well. So for investors with equity in a home or even an LLC owned investment, this is revolving and it resets each time a deal exits and replaces term loans at a lower rate. Or you can stack it on top, however you want to go. Business lines of credit. So investors with consistent revenue, a revolving facility drawn and paid across multiple simultaneous deals. So let's go a bit deeper and why this sequence is everything. So each tool involves a credit interaction. Get the order wrong and you compress approvals across every layer. Get it right and the total out of pocket goes to zero. So we start with debt consolidation if need be. So this starts at a 650 credit score. If we've got to consolidate credit card debts, auto loans into one more manageable loan at a lower rate to free up monthly cash flow and also boost your score. We can then move into stacking term loans together. Typically, we could get up to 40% of your personal verifiable income within 1 to 3 days. And then we can go and apply for credit cards. Once you've used debt consolidation to get your utilization down below 30%, this secures a full approval amounts. Now we can draw a HELOC, access after unsecured products are confirmed, and then a business line of credit is sustained ongoing deal flow. The consolidation step is the most underestimated. Rolling high interest revolving debt into a single fixed rate loan can add 40 to 80 points to a credit score in less than 1 month. So unlocking maximum approvals across every subsequent layer. Critically, consolidation and gap funding happen simultaneously. So you don't wait 60 days, then start. You're doing them at the same time, using term loans to both consolidate your debt and get into the deal for the down payments and closing costs. Now, the DTI and credit score effect. Two specific thresholds determine how much capital you can access across the full stack. So you got to have your utilization below 30%. This is going to be a great position to be in to go into a max credit card stack for banks like Chase, Amex, Citibank. They'll look at your personal utilization when making approval decisions. So a $2,000 utilization on a $6,000 credit card, that's, for example, 33% utilization. That's borderline, but still fine, and the lower the better. So if I am all off, then the lower the better. Now, getting utilization below 30% is a specific threshold that unlocks max 0% business credit card stacking at meaningful limits. Then credit utilization is also the fastest FICO score lever. Utilization actually accounts for about 30% of your FICO. So an investor carrying 25 grand across 30 grand in card limits, 83% utilization, who then go and consolidates, can see a utilization drop to near zero, potentially adding 40 to 80 points in less than a month. So, for example, you come to me, a gap funded at 650 credit score, 80% utilization. We can actually consolidate that to have you ready for credit card stacking at, say, a 720 within 1 to 30 days, dependent on when those cards' utilization actually update to your credit profile. So here's a real deal rundown, how the stack works in practice. We're going to look at a typical fix and flip. Say your purchase price is 185 grand. Hard money will cover 80% of that typically, so 148 grand. You've got your rehab budget at 40 grand, and that's going to be added to your hard money draws. So here's the gap. Down payment, 37 grand. Closing cost, 5.5. Earnest money deposit, 2 grand. Rehab draw float for the first draw period, 9 grand. Holding costs, 5 months, 8 grand. Reserves, 5 grand. So once you've calculated all of your costs and the gap involved in this deal, you're in for 66 grand, 500. A lot of people use their savings for this. But here's what we do instead. We're going to go stack term loans for about 25 grand, approved in 48 hours, covers down payment, closing costs, and the EMD in the account before closing day. Then we're ready for 0% business credit card stacking. For this example, we'll say 45 grand. We've stacked together 70 grand now. So across 3 to 4 cards at 0% APR, deployed via plastic for rehab floats, holding costs and reserves, zero interest for 12 to 18 months. Plastic's a tool we use to liquidate credit card limits as cash in your bank to use it for whatever you need it for, paying contractors, down payments, closing costs, and all of these use cases here. What's the result of this? You've gone into the property, total out of pocket $0. The property sells, loans are paid off, net profit stays with the investor, and your credit profile's strengthened. You're building business credit to be ready to rinse and repeat in 12 to 18 months once those 0% periods end. So here's the capital building effect we just touched on. Used correctly, gap funding doesn't just fund a deal, it builds your capital infrastructure as you go. So first, we've closed a deal, use the gap funding stack at zero out of pocket. We then repay that on time. We've shown that we can responsibly use this money. Term loans paid off, strengthen your personal and business credit profiles, as well as the cards. Now, your business cards are paid off, your business credit cards renew at higher limits. And you can actually go to the bank saying, hey, mate, I've maxed out these cards, shown I can pay them down. I need to expand these limits after every deal so that when we do go and restack in 12 to 18 months, they're going to go off your new average credit limit of your cards, which have built up over that 12 months. Now we can go and access more capital. The next deal starts with greater capacity than the last without touching savings. And so I want you to compare this to the investor using personal savings. They exit deal one with the same or less capital than they started with. Every deal depletes resources instead of building them, and the gap funding methodology is designed to compound. So who can access gap funding? This is crucial. Have a bit of an understanding of where you sit. So because the strategy spans multiple products with different qualifying criteria, here's exactly how it breaks down. So your term loan stack is that rapid gap funding. We can start there at 650 credit score, 700 for maximum amounts. And you're going to need a verifiable income because they're going to use Plaid to hook into your account. Check your last 3 months of deposits from whether it's into self-employed or business revenue for a business term loan. And then you want your DTI under 30% for the best results. If it is over that, then we can just use debt consolidation as your use case. No deal history required here. Then we're going into the 0% business credit card stacking. This is where we want to start with about a 700 credit score minimum. LLC will be required. It can be a brand new one, that's fine. And no revenue history required initially. Utilization under 30% for the best results, which is why we've used term loans to pay down credit cards before going into this. Then we are unlocking the HELOC, home or investment property with equity. So a lot of people don't realize they can actually pull the equity out of other investments they've already done. Say you've refinanced into a DSCR. If you've got a 660 credit score, we can actually go get the difference between what you still owe on that DSCR loan or your primary mortgage and 80% of the current market value. We typically check Zillow and Redfin to see where they might underwrite that property at for current value. Now you've got your business line of credit. If you're doing 20K a month in consistent revenue, obviously different NAICS codes, different industries are just based on consistency. You're going to be able to go and get a business line of credit. Credit history across business credit cards and trade lines are already in place to build these approvals up as well. So for the first deal, the term loan and business credit stack is going to be sufficient and 80% of what we do for newcomers. The HELOC and business line of credit unlocks your profile and track record, starts to develop to expand your capacity to scale faster. So let's go and close something. Gap funding is a strategy, not a loan. It's a systematic sequence of term loans, business credit cards, HELOCs, and business credit lines applied in a specific order to cover every component of a real estate deal that your primary lender doesn't fund. So here's what it delivers. It funds the deal at zero out of your own pocket. It builds capital capacity deal by deal, and then it enables more simultaneous deals over time and scales faster than investors relying on personal savings. So you can go and get a free funding review in the link in the description, gapfunded.com/book. Have a chat with me. We'll do a soft pull, no hard credit check. Within 2 minutes, I can tell you where you stand and we'll build out a strategy to start scaling from day one. Walk away knowing exactly which tools you qualify, how much capital you can access, and the sequence that gets you to your next deal. I'm Mick Wadley. Let's go and close something.